How is trading different from walking into a casino and betting on games of random chance? Is there a value to a trading strategy when markets are unpredictable? And how are markets fundamentally different to gambling? Let's get into it. Comparing the markets to a casino has become so much more prevalent today with all these gamified trading applications that are accessible to pretty much everyone. After all, these apps are designed intentionally to be fun, inviting, and addicting. Very similar to what you would find if you walked into a Las Vegas casino. Despite the lines of gambling and trading becoming more and more blurred, financial markets have one key attribute that fundamentally separates them from any kind of casino or gambling establishment, and that is the existence of a liquid two-sided market. What is a liquid and a two-sided market? To stick with the whole casino analogy, think of it as being a player in the casino, walking up to a blackjack table, but then having the option to be the house or the player. Fundamentally, casinos structure all of their games that there is an inherent negative expectation in every dollar that you wager. This negative expectation is also known as the house edge, and it refers to the percentage of every single bet that the house expects to win over long periods of time. For example, you sit down to play roulette, which typically has a 5% house edge on nearly all bets. Over the course of the next hour, you proceed to bet a total of $1,000 over the course of that hour. Now, regardless whether those bets won or lost, at the end of that hour, the expectation is that you would lose $50, 5% of $1,000. Now, it's important to note that that does not mean that every single session will have a loss of $50. After all, some sessions you could win or lose big. However, over multiple sessions and more dollars wagered, the actual outcome will get closer and closer to the expectation. In fact, the existence of a house edge is the only reason that casinos are able to make money over time. The key point to note here is that the house edge will be realized regardless of betting strategy that you use, meaning there's nothing you can do to overcome the fact that the more you play, the more you lose.
The longer they play, the more they lose. In the end, we get it all.
When you go to buy or sell something in a liquid market, you will notice that you're able to buy something at nearly the same price as you're able to sell it. In fact, we did a whole video on Are Markets Really Fair? You can find that video in the description below. Because the price in a liquid market is fair, this means that there is no advantage or disadvantage regardless if you're the buyer or the seller of that product. Because neither the buyer nor the seller are at a statistical disadvantage when they place their trade, there is no inherent negative expectation in the markets. This also implies that strategy and risk management are both relevant when trading. Strategy being the trade or combination of trades that would lead to a favorable outcome if your assumption proves correct, and risk management being the way you protect your portfolio in the event of an adverse market move. Every trade in your portfolio has a purpose to being either part of your trading strategy or your risk management. Think of a single trade as being a tool in a toolbox that is useful for some things and useless for others. Some trades are useful for capitalizing on big market moves and actually make you lose money if the market doesn't do anything. Other trades help you capitalize on rising markets and do nothing to defend you from falling markets. Contrast this to a casino game where regardless of the bet that you place, all bets are subject to lose over time. The reason that the wagers that you bet in a casino result in a slow but sure decline is because you have no option to take the casino side of the trade. The markets, on the other hand, are the only legal institution where an individual could set up a trading strategy where they can actually be the house. Now, this doesn't mean that all trading strategies will be profitable over time. And in fact, there are still a lot of negative expectation trades you could make in the markets. But there are also a lot of positive expectation trades that you could make, meaning that the more you trade those, the more money you'll make over time. The point is, when you set up a portfolio that utilizes a variety of different trades, you can make a trading strategy that could be profitable over time while also setting your risk management to protect your portfolio against adverse market moves. Over the next handful of months, we're going to be talking about what kind of strategies work well in different kinds of markets, and we'll also start to understand the fundamental difference between a positive expectation and a negative expectation trade. Thanks so much for tuning in today. I really appreciate it. If you like content like this, please make sure to like, subscribe, so you can get notifications from this channel whenever we post a new video. I'm Anton Kulikov, and I'll see you in the next one. Bye-bye.